Hey everyone, thanks for joining us today. We're just going to wait a couple minutes for everybody to tune in. We'll get started in about 2 minutes, so grab your coffee, grab your water, grab your notepad, and we'll get started in a couple minutes. All right, it looks like we've got a good group of people here and we are live on Facebook. So let's dive right in because we've got a lot of ground to cover today. So first, I'd like to thank everyone for being here for our follow-up webinar on the Canada Emergency Wage Subsidy. I'd like to first acknowledge that we are on the ancestral and unceded territory of the Coquitlam First Nations. Throughout the pandemic, the Chamber has been here to support the business community in every way that we can, whether that's providing resources, hosting webinars like this, or the launch of our Support Local campaign, where we're encouraging you all to support your local small businesses. We will continue to be here and support throughout the pandemic and moving forward. If you need anything, please don't hesitate to reach out to myself or Mike. We're happy to help you in any way we can or connect you to people that can help and answer the questions that you need. So without further ado, I'd like to introduce our speakers for today, the experts on the wage subsidy, who come from MNP LLP, a leading national accounting, tax, and business consulting firm in Canada with a local office in Newport Village. One of our experts today is Ryan Gorder, who is a CPA CA partner and business advisor with MNP. And we also have Catherine McCauley, who is also a local CPA CA and partner who specializes in Canadian tax. So without further ado, I'd like to thank Ryan and Catherine for being here and turn it over to you.
That's great. Thanks, Stephanie. Now, can everyone hear okay and see the cover page to the presentation? Okay, perfect. So thanks, Stephanie, for helping to coordinate the webinar today and having MNP present with you. Stephanie mentioned we're going to be discussing the changes to the Canada Emergency Wage Subsidy, which throughout we're going to just refer to as CEWS. As a brief intro, I'm Ryan Gorder. I'm a partner with MNP in our Port Moody office, and joining me is Catherine McCauley, who is a tax partner with the firm specializing in Canadian tax for most of our private companies and owner-managed businesses.
Good afternoon, everybody.
And so, as some of you may recall, we did host a webinar with the Chamber back in April when the original CEWS 1.0 was released. So this has subsequently been extended as of July 19th. And in this announcement, the government has released some significant changes to the program. And so while this announcement was certainly welcome news, as it expanded the program, which is going to allow many, many more businesses to qualify, it also significantly increased the complexity of the program. In several articles written by different tax analysts, they've referred to it as a cobweb of complexity, massively overcomplicated, and various other descriptive terms. So hopefully today we can help untangle that a little bit for you and give you a good foundation to help you when you start assessing and completing the the new period claims. Just a couple of sort of housekeeping comments. We're largely going to be focusing on the CEWS 2.0, of course, and what has changed and what you need to know. If you want any details on the original program, definitions, calculations, I just refer you back to the April webinar, which is still available on the Chamber website and Facebook page. And second being, many tables on here are going to be, they're developed by our national tax group, who've spent, literally hundreds of hours analyzing the legislation and correspondence with CRA. So they're going to be very detailed. We'll try not to get too technical. I know we've got a wide audience today, but certainly it's going to be something that hopefully you can use as a resource and go back and review some of the tables and data that we have as you start completing your claims. So just a brief point on our firm. So MNP is the 5th largest accounting firm and tax consulting firm in Canada, serving the mid-market. We're a truly Canadian firm. We've got local community offices, across the country. And our Port Moody office, which is located in Newport Village, has been here for about 12 years now. And we're certainly looking forward to being part of the Tri-Cities community going forward. Our agenda will do a brief refresher on the original CEWS, highlight some key changes that you need to know about and key differences. And then myself and Catherine will walk through a detailed comparison of some of the items between, what we'll refer to as 1.0 and 2.0. Then we've got a couple of key items, tips and recommendations, and really, what this all means, for your business at the end of the day. So going through a brief refresher, so the wage subsidy, it's a program obviously provided by the federal government for qualifying businesses that provides a wage subsidy on eligible remuneration paid to an eligible employee. The original CEWS, which commenced March 15th, provided a 75% subsidy, and it was originally a 12-week period, which has since been extended a couple of times with the most recent announcement, July 19th, which is retroactive to what is period number 5, which starts on July 5th. And so even though it wasn't announced till the 19th, and we're still kind of working through things, it is actually retroactive to the start of the 5th period on July 5th. And CRA has announced that the application process is going to be opening on August 17th. So you still have lots of time to kind of dissect the new rules, learn the calculations and go through these to make sure, everything's in order before submitting. There's 4 general, criteria to be aware of: the eligible employer, what is qualifying revenue, what is an eligible employee, and what is eligible remuneration. And so our original webinar really goes through those in detail, but we're going to highlight, what is important to know on CEWS 2.0 and how it impacts those definitions. So looking at some of the key changes, really at a high level, at a glance, there's kind of 4 main categories or criteria on the left here that you'll see that have had some significant changes to them. So the first being the claim periods. And so the CEWS 1.0 is applicable to the periods 1 through 4, which runs March 15th until July 4th. And then CEWS 2.0 starts with period 5 on July 5th forward and runs until the end of period 9, which is November 21st, 2020. Now, there is the potential for a possible extension through to December 31st for the period 10. It's already written within the legislation, so they do have the ability to add that, to easily add in 1 extra period if need be, without having to redo any of the legislation that's been approved already. The second area is the benefit and subsidy. And so under CEWS 1.0, the subsidy was up to 75% of the remuneration paid in respect of a week, and that maxed out at $847 per employee per week. And now under 2.0, starting July 5th, it is based on a sliding scale. And so the subsidy could really be anything from 0 up to $960 max per employee per week. And it is purely dependent on what your actual percentage of revenue decrease is. Now, looking at the revenue reduction, under CEWS 1.0, it was a all or nothing. You had to have either 15% in March or a minimum of 30 in the subsequent periods in order to qualify. Under 2.0, there is no minimum. Any business with a decline in revenue could potentially qualify for a subsidy claim, and that amount will be driven by what your percentage of revenue is. So that's really one of the huge changes that has opened up this program to many businesses, many organizations that maybe otherwise would not have qualified. And then the fourth one being an eligible employee. So an eligible employee is anyone employed in Canada on payroll. And 1.0 had a rule in it that excluded any employee that did not have remuneration for a 14 consecutive days within that period. And so this was a rule that caused a lot of issues for many of our clients. If you think those, each period is 28 days long. And so if you had any individual that you rehired, say midway through the third week of that period, because the first 14 days they were not paid, they were actually not eligible for that final week in that period. It also caused some problems with businesses that were looking at laying off individuals, because if you did it too early in the period and they went 14 days without pay in the second half of that period, they were also ruled out, and any pay to them was then would not qualify. And so it really created a situation where employers had to strategically determine their dates of hirings, rehirings, layoffs, and that sort of thing. And it just made the program even more complex. So the good news is under CEWS 2.0, that has been eliminated. And so from July 5th forward, even if you rehire an employee for a single day in the period, you are eligible to claim the subsidy for what they're paid for that time. Now, looking at some other highlights, starting with the eligible entity with a revenue decline is now eligible from period 5 onwards. So that's what we discussed previously. Opens the door for a lot of organizations, and we can discuss which organizations are eligible in a couple of slides. In terms of the actual calculation of the subsidy, it's going to be broken now into 2 components. The first component being a base subsidy, which is going to be driven by your 1 month change in revenue for the current period. And they've added in an additional top-up subsidy for those organizations where the revenue decline exceeds 50%. And then that will be driven by a 3-month average reduction calculation. The revenue reductions will then determine the percentage of your subsidy. And so as we mentioned, if your revenue reduction is greater than 50%, it will be different rules. And if it's below 50%, you'll fall into this category of the sliding scale. And Catherine will go through some detailed summaries, and we've got some good tables that outline how that works. Some other changes, period 5 and 6 are somewhat transitional periods in terms of your ability to choose the CEWS 1.0 or 2.0 rules if your revenue decline is over that 30%. And so although that 30% threshold isn't within the new rules, during period 5 and 6, if you're over 30, you can in fact apply the original rules if that results in a higher subsidy claim for you. If your revenue is less than 30%, you must fall into the new CEWS 2.0 rules. And then also of note is starting in period 5, the baseline remuneration is only relevant for a non-arm's length employees, and we'll discuss that in a little bit more detail. And the deeming rules have also changed. So these are the, what's often referred to as the safe harbor rules. And so those have changed starting in period 5, and those are really important to understand. We get a lot of questions on this, so something we'll help try to clarify as well. And another change is that furloughed employees now also have different rules for periods 5, 6, and onward. So getting into our comparison, you'll see here this table which outlines the qualifying periods. So version 2.0 rules come into effect starting in period 5 on July 5th. And now obviously many people, given, we're at August 6th here, so lots of people are starting to look back at this claim. So it's important to know these new rules as you start to look at your period number 5. And it is currently set to expire on November 21st. And as we mentioned, there's possible extension for one additional period to the end of the year at December 31st. Now, for the prior reference period, this is important in terms of what you use to calculate your percentage of revenue decline. Even more so now because it directly drives the percentage that you'll be able to claim for your subsidy. Before it was a strict 30% hit or miss, and then now it's based on that. And so the standard reference period, which is what you're comparing your current month revenues to, the standard used is the same month in the prior year. So if we're in April 2020, we're going to compare our revenues to April of 2019. What could also be used is the average revenues of January and February of 2020. And so this was often used if you filed an election, to use that period for periods 1 to 4. And also in situations for new businesses, startups, that sort of thing, if maybe you didn't have business going on last year. And so your prior reference period would have very limited or no revenues. You can actually use your January, February. So that hasn't changed. The main difference is that for period 5 onward, you can actually elect to change the reference period that you've previously used. So under the old rules, if period 1, you had elected to use the average of January and February of 2020, you were stuck with it. You had to keep that reference period for all periods 1 through 4. Now, starting in period 5, it can be elected differently. And so that's a welcome change, just to add some flexibility to people's claims. Now, looking at the baseline remuneration, and so for the most part, it is the same. This is an important item in terms of calculating your actual wage subsidy, as it results in actually being a limiting factor. So under the old rules, when you did the calculation, it was actually built into the formula to provide somewhat of a limiting factor, as you had to compare it to the baseline remuneration earned from Jan 1 to March 15th, prior to the subsidy coming into effect. And now in version 2.0, that is effectively the same. However, what they have added is a special election that you can file when you submit, that allows you to actually look back to a period in 2019 for calculation of the baseline remuneration. So again, it's another added election where where it builds in some flexibility. And it adds, it would be used in a situation where perhaps an employee's compensation was different in 2019 versus early part of 2020. For example, seasonal workers and that sort of thing that maybe had larger wages. last year and not so much in January, February. So this allows you to elect to use either the 2020 Jan 1 to March 15th or the periods in 2019. And the table on the left there breaks down what those elections are. Now, just some more on baseline remuneration. So for period 5 forward, the baseline remuneration, you do not need to calculate it for arm's length employees. It is not a factor in the calculation. And the only time you would need to is if you are electing to use the different period, but it doesn't make a difference for an arm's length employee. It's not built into the calculation. However, for non-arm's length employees, such as your shareholder owner that's on payroll, this still is a limiting factor. And so it's important to know which periods you want to use for that. And effectively, this, the baseline remuneration rule is really intended to prevent non-arm's length individuals from being subsequently added to payroll in order to just claim the subsidy. You had to have a track record, a history of actually paying wages to those non-arm's length individuals. And so you can't, as of March 15th, you couldn't just add on a bunch of shareholders and, direct family members to payroll and start claiming the subsidy if they did not have a prior baseline remuneration. Just on that topic, we'll talk about CRA sort of audits and enforcement, but this is likely to be an area of additional scrutiny by CRA once they start auditing, is if you indicate an individual is non-arm's length, you're likely going to have to prove the prior reference period baseline remuneration, and it's going to likely be a target area once they start doing the audits. Now, for eligible employees, this includes any individual employed in Canada, so you must be on payroll. No changes at the end of the day. Everything is very consistent. The only difference being the 14-day rule is gone. It doesn't exist under 2.0. And a reminder, obviously, it must be on payroll, so independent contractors and dividends to shareholders, which was widely believed to be unfair to owner managers taking dividends. Those do not qualify, and they still do not qualify, despite being included for other programs. They did not change that for CEWS, so the dividends still aren't don't qualify for the subsidy. And so for eligible entities, they are also identical from 1.0 to 2.0. However, you'll see in the middle under prescribed previously, when the original legislation was released, there were a number of entities and organizations that were not included in the scope directly. And after consultation with the government, they were subsequently added. And so this would include certain Indigenous-owned entities and organizations, private schools, colleges, and other related organizations here. And so after those were subsequently added under CEWS 1.0, they are still in effect under 2.0. So no changes. Any corporation, nonprofit, registered charity, unions, labor organizations are all still eligible for the subsidy. And so I will now pass it over to Catherine to discuss some of the revenue criteria and other calculations.
Great, thanks, Ryan. So over the next several slides, I will be explaining how to calculate the revenue reduction. In the original CEWS rules, there was a hurdle. You were either in or you were out. If you were out, you were not eligible at all. If we compare two employers for period 2, and one had a revenue reduction of 29.5% and the other had a revenue reduction of 30.5%, even though there was only a 1% difference, only the employer with the revenue reduction of 30.5% qualified for CEWS. So MNP was provided the opportunity to speak to the House of Commons Standing Committee on Finance. One of the asks by MNP was to have the wage subsidy calculated on a sliding scale. We were happy to see that this was implemented in CEWS 2.0. Entities most impacted by COVID would be eligible for a larger subsidy versus those with less impact, and the bright line test has been removed for period 5 onward. Starting in period 5, if you have a revenue decline of equal to or greater than 50%, the subsidy will be greater than if your revenue is below 50%. If your revenue decline is below 50%, you're eligible for the subsidy, but it will be on a sliding scale. Because there is no longer a hurdle, every eligible employer with a revenue reduction is eligible for CEWS. So here we are, there's 2 different components of revenue comparisons that must be calculated from period 5 onward. These are calculated separately. The first is the revenue reduction percentage. This is the comparison of the current month revenue compared to the prior reference period. This calculator will determine the base subsidy for period 5 onward. Secondly, there's a top-up revenue percentage, and this will determine if you qualify for a top-up subsidy. Next slide, Brian, yeah. So if we're looking at the top-up subsidy, the top-up revenue percentage, the comparison looks at the last 3 calendar months prior to the current reference period in comparison to the prior reference period. So let's walk through an example. So if we're looking for July 2020, we need to calculate the average qualifying revenue for the last 3 calendar months. So that would be April, May, and June 2020. And we would compare that to either the average of January and February 2020 or the average of the same 3 calendar months, so April, May, and June 2019. And that would let us determine what our percentage decline is for the top-up. So if the revenue top-up, for the revenue top-up subsidy, if your revenue reduction is greater than 50%, then you will be eligible for the top-up subsidy. You may recall from CEWS 1.0, the subsidy was capped at $847 per week for each eligible employee. $847 was calculated at 75% times $1,129, which was the maximum weekly salary. So the number from period 5 onwards continues to consider this $1,129 maximum weekly salary, however, using different percentages as we will outline. For every 1% change in the 3-month average revenue decline, there will be a 1.25% change to the CEWS subsidy, and the maximum that can be obtained is $282.25. So this table highlights the various revenue reduction calculations that need to be determined in each period. We are calculating revenue declines of 30% or more, under 50%, equal to or greater than 50%, and then there's a max top-up percentage. For periods 1 through 4, there's only one test. Was there a 30% or greater revenue decline? For March, the revenue decline test was 15% to take into account that COVID did not start having a significant impact on entities until the middle of March. If you meet the revenue decline threshold of 15% for March or 30% for periods 2 through 4, there could be a 75% subsidy up to a maximum of $847 per week, which, as stated previously, was equal to 75% of the $1,129 weekly maximum salary. So for periods 5 and 6, because of the safe harbor rules, you can choose to be in the old rules if you have a revenue decline of 30% or greater and obtain a 75% subsidy. You might wonder why you would choose to be in the new rules if you qualify under the old rules, and the answer to that is the top-up percentage. For those businesses that have been the most impacted, they can be eligible for the base subsidy of 6% plus the top-up percentage of 25%. For a total of 85%. This would occur if the business had a 70% or greater revenue decline in the previous 3 months and a 50% or greater decline for the current reference period. For period 7 onward, the only option is under the new rules. You'll notice that there is a gradual decline of the subsidy. For businesses with less than a 50% reduction in period 5 onward, the subsidy percentage is tied to the revenue percentage decline. So if, for example, your revenue decline for period 5 is 10%, your subsidy would be calculated at 1.2 times 10%, so it would be 12%. I'll go through an example in the next slide. And just an item of note, the top-up calculation is mutually exclusive to the base subsidy. So if the business has an improvement in the current month compared to the previous 3 months, it might only be eligible for a small base subsidy. But if the prior 3 months had an average revenue decline of more than 50%, it could still receive the 25% top-up subsidy. So next slide. So this is the example I wanted to outline. So this would be for an entity that has received a revenue reduction of less than 50%. And if we're going to assume that this is in period 5 and the eligible remuneration is $1,000, we would take $1,000 times 25% times our 1.2 factor for period 5. So it would be $300 per week. So next slide. So furloughed employees. So furloughed employees are employees who are on leave with pay. There a lot of entities were continuing, because of the subsidy, we're continuing to pay employees, and businesses who keep furloughed employees on payroll in addition to the subsidy were eligible for employer paid CPP and EI. So there were some changes. So for periods 1 through 4, nothing was changed in CEWS 2.0. And for periods 5 and 6, there's a special rule that as long as there is revenue decline in the current period or in the prior 3-month average, then the subsidy is still 75%, which is based on the old rules. And for periods 7 through 9, we do not know the extent of the rules, other than we know that there needs to be a revenue decline in the current period or 3-month average. And the final amounts will be determined by regulation, which have not been released. I think there's been some commentary that they're going to try and match this to the CURB program. So we should get details later on about what that maximum amount will be. And for non-arm's length employees, it's important to note, and Ryan talked about baseline remuneration earlier, but if there is no baseline remuneration, then they will not be eligible for the subsidy. Essentially, if the employee is related to the employer, so a shareholder, shareholder's spouse, then you can't hire them now as an employee and put them on leave with pay to collect the subsidy. Next slide. So this table illustrates the maximum subsidy for different periods and for different revenue declines. As you can see, there is a gradual phase out for periods 5 through 9 for revenue decline of 50% or more in the current period. It starts at $677 and gradually declines down to $226 for period 9. If we are looking at a revenue decline of less than 50% in the current period, the subsidy starts at 1.2. Times your revenue decline, and then it lowers to 0.4 times your revenue decline for period 9. And if we have a company that hits the maximum subsidy, including the maximum top-up, then for periods 5 and 6, they would receive $960, and by period 9, the amount of the subsidy is $508. As mentioned earlier, if you have a revenue decline of 30% or greater in periods 5 and 6, but you are not eligible for the top-up percentage, then you would choose to go under the old rules and receive the maximum subsidy of $847. And this table here shows the maximum subsidy percentage available for different revenue declines. The amounts highlighted in green assume that the employer has qualified for the maximum top-up subsidy. And for periods 5 and 6, the maximum subsidy is 85% for revenue declines between 70 to 100%. So that's what we talked about earlier with the 60%, but plus the 25% top-up. And also for periods 1 through periods 4, it was possible to receive 100% subsidy for employees who were earning less than 75% of their pre-crisis eligible remuneration. As baseline remuneration has been phased out for arm's length employees for periods 5 onward, we did not show that in this table. So when the revenue decline is lower than 50%, as the subsidy phases down to a lower percentages, business will need to weigh the cost benefit of applying for the subsidy. For instance, for a 10% decline in revenue in period 9, the maximum weekly subsidy is $45 per employee. So you'll have to kind of determine you know, the steps involved to document your revenue decline, your you know, making sure we have all that backup in support of a CRA review. You know, does that make sense if it's only, you know, $45 per employee, and that will be determined on how many employees you have and many other factors to consider there. So the deeming rules. So has been a lot of discussion on the deeming rules. And there are changes with CEWS 2.0. Ryan touched on this earlier. Under version 1.0, if you were eligible for one period, you would automatically be eligible for the next period. So you would calculate your revenue decline for period 1, and if you met it, then for period 2, you would automatically be eligible. And there was some confusion over the legislation. Some people thought that if you qualified for one period, then you would qualify for all of the next periods, but that wasn't the case. So then you would go ahead and calculate for period 2, and if you met for period 2 on its own, then you would be deemed to met for period 3. In 2.0, there's still a deeming rule, but it's changed, which we talked about. So next slide, Ryan. Under the new rules, rather than being eligible for the immediately following period, the criteria has changed. First, you must have a revenue decline in the current period in order to be eligible for the subsidy. So there has to be some sort of revenue decline. And if you have a revenue decline in August, you can look backwards to see what your revenue decline was in July. If July's revenue decline is higher, you will select July's percentage for your August CEWS claim. If August is higher, then you would choose August. This will allow you to maximize your base subsidy. Because we now have a base subsidy, a base claim and a top-up, the deeming rule applies to the base claim but does not extend to the top-up subsidy. So very important to know that. So you must meet the revenue decline for the top-up subsidy on its own for the current period. So if we look at the example on the slide, if in August our revenue decline is 27%, and July our revenue decline was 33%, then for our August period, we would choose to be under July because July would have the higher decline. Sending it back over to Ryan to talk about other key items.
That's great. Thanks, Catherine. So we got a couple slides on some other, specific highlights and key items we wanted to point out. First being related to the revenue. So you still have the option to elect to use the cash basis to calculate your revenue. So nothing significant has changed there. The accrual method is generally what we see. It's fairly standard. It's just simply driven by your normal accounting policies. And just one thing to note is that if you elect to use the cash method, you must use that throughout the life of the program. And there hasn't been any change to that. And so that will basically continue from period 1 right through to period 9. In terms of the, the revenue, as I mentioned, it's based on, your normal accounting policy. And so, there is a CEWS hotline, which many of you may have been calling and asking questions. The agents there have tended to always refer back to, the client's individual, normal accounting policy. So when we're trying to assess for one of our clients what, whether an item should be considered or not considered, the fallback is, what is your normal historical accounting policy, and you should maintain that and continue it, and then treat it the same way in the reference period that you are comparing it to. In terms of the individual entity versus affiliated group method for calculating revenue, so this really only applies to a business that may be a part of a corporate group with affiliated businesses. If it's a single, owner managed one operation, you're simply calculating it based on your individual business revenue. However, if you are part of a group, and we see this quite often with different types of organizations that maybe have 2 different locations or 2 different branches in 2 separate corporations, you can elect to consolidate your revenue and calculate it on that method. And so you do have the opportunity to switch between these 2. And so we've had lots of clients where they were using the consolidation method for periods 1 through 3, because perhaps 1 or 2 of their companies, didn't meet that hurdle, but using the consolidation method, we were able to get them there, and then all entities would qualify. And then they can switch depending on whether, once things started to pick back up, maybe the consolidation method wouldn't reach that 30%. So you can then switch and go calculate it based on an individual method. And so nothing there has changed. There are special rules relating to business combinations. These are very case specific, so we won't get into any examples or details on that. But if you're involved in a business that was perhaps had an amalgamation in the last year, there was an asset purchase or sale, and there's different ways of trying to figure out what that prior reference period revenue may be. There are some special rules. So if that's the case, I would just recommend, contact your accountant, your advisor to help walk you through what those are. In terms of amending past claims, there is a way now that you can log on and amend a previous claim. And we're recommending, obviously, it's better to do that proactively. If you do, as more and more information is released and CRA continues to update their FAQs, and we get more clarity, we have seen where people are identifying that maybe they missed an employee that was eligible, or they've miscalculated. So you can go and amend that and update it, and obviously do that before CRA comes in to take a review in order to try avoid any penalties or interest. In terms of timing and deadlines, you'll recall from the first webinar we did back in April, we were suggesting to take your time, wait for clarity on the rules. You didn't have to, you had until the end of September effectively. Well, that has also been extended, and it's retroactive all the way back to period 1, and so you have until February 2021. So effectively, January 31st is the deadline now for the entire claim period to get those submissions in, and so you still have lots of time to resolve any uncertainties and to go through these calculations until basically the end of January. In terms of CRA audits, the CRA has announced that they are going to be beginning preliminary audits starting in the summer. And so here we are, halfway through the summer. And so I expect that to be coming up fairly soon. Obviously, as everyone's businesses and everything is reopening, so is the CRA. Their activity is picking up, and so we would expect to start seeing these coming, in the near future. We get a lot of questions on documentation requirements. What do I need to have and keep on file? The important thing to know is the onus is going to be on the employer to prove that they qualified and to prove that their calculation was correct. And the 2 main areas that we would anticipate you having to support would be, first, the reduction in revenues, in terms of proving that your revenues were down, meeting the threshold, showing the support from the prior period, and then also the calculation of the eligible remuneration. And so we're really recommending, maintain some sort of file or folder that has all your, there's lots of templated calculations, but there's a lot of data that feeds into that. There's payroll reports, there's financial statements and accounting details from past years. So keep all that on file. And also for non-arm's length employees, you're going to likely have to support that they in fact had baseline remuneration. So make sure that those payroll documents and details are available. And do that now, as you prepare this, because as these audits are starting, it could be the next couple of weeks, but it could be several months, it could be a year or even longer, where a lot of this information and assumptions is going to be lost, and it's going to be a lot more time and effort to have to go back and sort of reinvent the wheel to support this if you're in an audit situation. And also there is a signed attestation form, the RC 661. And so this should be dated, signed, and kept on file. And it's got to be dated as of the date of the submission. It can't be done afterwards. And that's likely one of the first things that CRA is going to request when they request information. Now, if you do find yourself in a situation where CRA has come in and they issue a notice of determination where they do not agree with either your eligibility for the revenue or your calculation, you'll have to repay all of it or a certain portion of it, and there may be penalties, but you do have the option to object to that, and that must be filed within 90 days of the date of the letter of their notice of determination. So it's not the end of the world if you strongly believe that you were correct and that the CRA auditor may have made some wrong assumptions or came to the incorrect conclusion. You do still have the opportunity to object to that. But I would suggest, again, in a situation like that, strongly recommend seeking some professional advice in terms of the objection and what to include. So now, what does this all mean, for your business and in your organization? The CEWS 2.0 there's a lot of changes and a lot of complexity, but it is really an expansion of the program, and a lot more people and businesses and organizations are going to be eligible. So you're going to need to re-review your eligibility. 1.0 was a hard and fast rule. You were in or you were out. It was pretty straightforward to do the revenue calcs. But now, obviously, starting in period 5, you may be in even if you never qualified for a previous period. So I know there's a lot of, a lot of businesses out there that may just assume they don't qualify because they never have. But that's not necessarily the case, and they may be missing out on some opportunity. The rules are complex. They're hard to navigate. More information still is going to be coming. We're expecting CRA to be releasing, further updates to their FAQs. I think the most recent one is still July 9th. And so with the CRA not opening up the applications until the 17th, we're hoping that they're going to update these to provide additional clarity, prior to that. But if you are, if you're not sure, seek some advice in terms of whether you qualify, how to calculate revenue, what goes into it, what you need for support, how do these calculations work, and get the assistance you need to make sure that you're having it done correctly. In terms of the templates, I know CRA had a useful template that you could use for CEWS 1.0. It's not been updated yet, but we're hopeful that they're going to be releasing that prior to August 17th. There are some tax law firms out there that have built their own that you can purchase, but hopefully CRA will release one that's available to the general public that everyone can use, that's including all these new formulas. We have one build that we use internally, but hopefully one will be made public that everybody can download and use to help get their calculations. So continuing on you and your business, what does this mean? CEWS 2.0 is really the beginning of the end. It is a gradual phase out and wind up of this program. So this and other programs are slowly coming to an end. The tax deferrals, filing deadlines, those are all coming due. The subsidies and other financial support are slowly winding down. So really ensure you're taking the time before these are fully run out to invest in your business to come out stronger. Obviously there was a point, and some businesses are still in survival mode, but really take the opportunity, whether it be capacity planning, new technologies or markets, business improvements, efficiencies, streamlining corporate structures, focus on coming out stronger, once all these eventually come to an end, so you're in a position to really, be successful in the new environment. And then finally, despite the challenges and significant adversity that it's caused, that COVID-19 has caused, there are still some opportunities it's created. Specific from a tax planning perspective, we've been doing a lot of looking at, estate planning from estate freezes. If people have gone through a recent estate freeze, perhaps looking at doing a thaw, whether it's time to bring in a family trust, if there's values that are potentially depressed. There's a lot of cash extraction strategies to be used with regards to, capital dividend account, managing your capital gains and losses during this time as well, capital gains planning, and also loss utilization planning. There's a lot of businesses that are going to be incurring, losses for tax purposes this year. So it's making sure if you're in that situation, how can you, make the best out of a bad situation and utilize those losses in a tax planning strategy to give you the most benefit, whether it be loss carrybacks or, potential amalgamations and that sort of thing. So there is a lot of opportunity out there. And so just make sure you're working with your advisors to, be proactive and take advantage of those that are available. And so that is everything that we had to cover today. So thank you very much, Catherine, for all your expertise and joining me today. And thank you, Stephanie and the Chamber for having us online for the webinar. I know it's a lot of information, but as I mentioned before, hopefully as this will be saved on their website and Facebook page, if you need to refer back to some of the more detailed content, you can. And certainly if you do have any specific questions or need some clarity on your business, our contact information is there, so feel free to reach out to us at any time. We're here to support you and happy to have a conversation about any questions that you may have. And so with that, I will turn it back to Stephanie to walk us through some of the questions that we have.
Awesome. Thank you so much, Ryan and Catherine. That was a lot of information. I know it's going to be helpful having the webinar recorded and saved on our website so people can go back and kind of process and go through it again and check out those slides and graphs that you guys made available. We did have some pre-submitted questions, so I'm going to hop to those first before we go to the ones in the chat. We have about 8 minutes, so let's see how many we can get through. The first question was, have you seen how less than 30% will work? Do you know if they extended the deemed eligibility? If someone has met revenue criteria in a period before, is there an option to have deemed period?
Yeah, so Ryan, if you wouldn't mind, can you go back to slide 24? This is the one that talks about the deeming rule again, but I think it would be good to just talk about it again because it is a little bit, it's different.
Are you able to see that there?
Yeah, so it's different. So for CEWS 2.0, it's different than CEWS 1.0 in that you do have to have the revenue decline in the current period, and you can use the current period revenue decline percentage or the immediately prior revenue decline percentage, whichever is higher. And remember that this is only for the base subsidy payment, and for the top-up subsidy, you must qualify for the top-up each and every month on its own. And for the revenue reduction percentage, if we go back to slide 17 there, 17 I think has the so if we're less than 30% for period 9, you would multiply a factor of 0.4 by the revenue percentage decline and then determine the percentage of remuneration eligible for recovery. So if the revenue decline was 15%, we would multiply that by a factor of 0.4, and assuming the eligible remuneration was $1,000, the total weekly subsidy available for period 9 would be $60. That's the change. So that kind of answers the two questions there, Stephanie.
Awesome, thank you. And does that, confirm then that the revenue decline needs to be calculated at every claim period?
Yeah, and so definitely, especially now that we're on the sliding scale, like you want to calculate it because you want to, first of all, you want to know that you can use your deeming rule, because you do need a percent decline in order to qualify for the deeming rule. And secondly, you really want to take advantage of which period is higher, the current period or the prior period, because that will just result in your maximum subsidy claim. So you would need to calculate it every period.
Awesome, thank you. And I know you touched on this as well. This is a pre-submitted question of the calculation template. So I think, Ryan, you mentioned you were hoping one would be coming out from the government. Have you heard any confirmation of that, or they're working on one, a new one?
So I don't believe anything's specifically announced in terms of if and when. I would anticipate, given the complexity, that CRA will issue something. I mean, they did before, and the calculations only got more complicated. So I can't see them not. But if they happen not to, there are firms out there, notably tax law firms I've seen online that have created them. Unfortunately, you likely have to buy them. So I would just be patient and wait. And in all likelihood, CRA will be releasing one.
Okay. And I just got a private message on a follow-up to that. Does that mean that the revenue calculation at each period would be part of the filing calculation template? And maybe even for those making private templates, do you think that would be included?
While the revenue, it's likely not as part of a template, because it's very different based on your individual organization. And for a small organization, the revenue comparison could be fairly straightforward. It's just printing your income statement from April of last year and comparing the revenue to April of this year. Obviously, it can go from that and get a lot more complex, especially if you're doing the affiliated group method. But for the most part, when we're working with clients to help them through this, we're just we're kind of doing it on a one-off custom basis, because everything can be so different in terms of the complexities of the revenues, what periods you're using, and that sort of thing.
Mm-hmm. Okay. Can you quickly just pull up the slide that showed the actual amount that would be reimbursed as the CEWS is phased out? And as you do that, I'm going to just read out the next question, which is, I have an employee that I have not been claiming CEWS for. His average weekly earnings pre-COVID were $730 per week. He's wondering if I can give him admin work so that I can give him the maximum of $1130 per week. If I oblige, would I be able to claim the $1130 per week, even though his weekly average pre-COVID was only $730?
Yeah, and so if they haven't been claiming CEWS, assuming they likely didn't qualify for the prior, the CEWS 1.0 periods 1 to 4. So if there's a revenue decline and you would qualify starting in period 5, remember the baseline remuneration is no longer relevant, assuming that individual is an arm's length employee. So you could increase that employee's wage for extra work, starting in period 5. But an important thing to keep in mind is, because that baseline remuneration is no longer applicable and the subsidy is going to be driven by your revenue decline, if you go all the way up to the max of $1130 per week, the employer is going to be incurring part of that. And as the periods go on, the portion of that the employer will incur that's not reimbursed is going to go up. And that, if you, for instance, the slides that we're on right now, as you can see, the revenue decline less than 50%, the qualifying periods on the left, as they go on, even with a 40% decline, the portion that you're going to be reimbursed is going to slowly decrease. So to answer the question, yes, you can make that claim, and the eligible remuneration, the fact that there was no previous remuneration doesn't matter anymore, but you're going to be incurring a cost now because it's being phased out.
Okay, thank you. for the RC 661, can it be a one-time completion for the client, or does it need to be per submission?
Yeah, so that would be completed per submission, because you have to, there's a spot at the bottom as well that says, you know, what is the amount that you're claiming, and you put that in, and so every submission that you make, you sign off on that attestation form.
Okay.
And it also includes, you know, check boxes for any specific elections. And because some periods there are elections that you can change as you go, those need to clearly identify for each period, you know, if and what elections you may be making.
Okay, I've got two more, hopefully really quick questions that we can finish off with. The CRA template for CEWS 1.0, did they produce one that was useful for semi-monthly payment, for semi-monthly pay?
No, so they didn't. And part of the frustrating thing about CEWS is that you're really fitting in between those very specific periods. And those periods are, you know, the 28 days, as Ryan had mentioned. So like, it doesn't work so well for the semi-monthly payments. You kind of have to figure that out. What did they actually earn in respect of that's this very specific pay period?
Okay. And last question before we wrap is version 2.0, what rule to add 25% top-up percentage? Does that make sense?
Yeah, so we talked about the top-up percentage, but essentially, if your top-up percentage revenue decline is, you know, 70% or higher, you would be at that. You would get to that 25% number. So if you look back, you can see on that slide that I had how you would get to that amount.
Okay, awesome. Well, thank you so much. I do have a couple other questions that were submitted to me privately that are a little bit more in-depth. So I will connect those with you, Ryan and Catherine, and maybe we could just add a little FAQ to the PowerPoint on our website so that people can get the answers to these questions as well. But I'd like to thank both of you again for your time today. It's a very timely, topical subject and very complicated to work through. So I appreciate you taking the time and having this presentation for us. And I'm wondering if anyone has any additional questions, if they're able to reach out to you with the contact information shown here.
Yeah, absolutely. So if anyone has any specific questions, feel free to reach out or you know, submit them to Stephanie at the Chamber, and we can work through them and get them posted as well, along with the final presentation, just so everyone can reference them. But by all means, you know, feel free to reach out to us at any time.
Awesome. Okay, thank you so much. I hope everybody has a great evening, and we'll see everybody soon.
It's great. Thank you, Stephanie.
Thank
Thanks,
you.
everyone.
Thank you.
Thanks, everyone.